Well, for those of you online, welcome. Today, we're going to be covering roughly the first half of Chapter 16. It's an introduction to management and accounting. It will be largely non-computational. There will be some computations, but not that many. And the next chapter, Chapter 17, is going to offer an in-depth look at management accounting using numbers. And that, as you know, is where we'll get in some T accounts and some journal entries as well. Well, here in Chapter 16, so we'll see management accounting or managerial accounting, same thing, but again, from a largely conceptual viewpoint, because I want you to get a number of ideas down pat first so that we get acquainted with what we'll study during the rest of the course. And then, as I said in Chapter 17, that's where we get into the nitty-gritty details of journal entries and T accounts and some of that good stuff. Not so much in 17. In fact, no journal entries or T accounts in this chapter at all for us. So let's go ahead and take a look here at Chapter 17 and I'm sorry, Chapter 16. And if you're online, I'm going to go ahead and share my screen. So here in Chapter 16, we're first going to, excuse me, get into how we help management. So as you know, we're managerial accountants. We're there to provide information to management, and we'll see how we can help them with their so-called accountability, with the things they're responsible for accomplishing. Once we've done that, then we're going to be reflecting on how, in this course, we provide information about a lot of different costs. We'll be dealing with that throughout the term. So we'll see some different ways of categorizing costs. We're also going to get into something called the value chain a little bit. You'll see how that means if we incur a cost before manufacturing, during manufacturing, or after manufacturing. We'll end about there. And then when we come back on Thursday, we'll be getting into how the manufacturing sector of companies differs from services companies, those sell services, generate revenues, and from merchandising companies, those which sell services, generate those which sell, pardon me, inventory that somebody else has made. So that's how they make their money. As a manufacturer in cost accounting, which is another name for this course, we'll see how we make that merchandise. So this is not a very difficult chapter. I think you'll be okay with it. So let's first of all talk about management accountability. Well, first, this is management's responsibility of various stakeholders of the company. So back in financial accounting, 2111, you dealt with the primary stakeholder of external users. So external users, most importantly, investors, to a lesser extent, creditors, to a lesser extent still, third parties. But in this course, no, we're going to be worried about internal users. That will be the primary stakeholder for us, specifically management, and we're trying to provide information which helps management do its job. So we'll think about why we do something, because it is for internal users, it helps them, and we're not going to have to worry about external users too much. And to tell you the truth, that's kind of a good thing from our standpoint, especially because here's one thing we'll see. We won't have to be very concerned about GAAP. Is that okay with everybody? Yeah, I think so too. Myself included. We won't tell financial accounting professors that, but I have to admit it. I teach this course on purpose. I'm department chair. I get to pick. So yeah, I picked this one. It's a lot more fun. Well, again, B, we know that basic difference. Financial accounting prepares information for external stakeholders. And management accounting, of course, prepares it for internal purposes. We'll see the contrast. Well, they're in the book, but I'm just going to go ahead and summarize the most important things out. Erase this, we'll get to it later. So for those of you online, let me come back to the board. Going to stop my share. Okay. Just portioning out my board space. All right. Which is really, really important to do when you're capturing it with camera. And unfortunately, those that design these classrooms don't teach them. If they were to, we wouldn't have these two great big screens up there. Just a little bit of board space to write in between. I wish the screens were maybe monitors actually up toward the ceiling. Now, if they were that way, I'd have plenty of board space. And also, if those designing the classrooms taught them, they wouldn't have this great big podium right up here in the way and have this great big screen here to block more. So if there's ever something that you can't see, just let me know. So let's talk about financial versus managerial accounting. We already know a lot of information about financial accounting, so let's put that into perspective with managerial. So comes to financial versus managerial. So financial versus managerial. Again, the very basic thing, the heart of everything, the basic difference is users. So external for financial, internal for managerial. So internal and external resource. External, again, we're talking about kind of general public there, but especially investors and creditors and some other third parties too. Here, we're thinking about internal users. How can we best help them? Now, when we think about that, that means then financial. We must have some strict authoritative guidance. And financial, That's GAAP. In this course, about the best thing you could say is company policy. Well, as we deal with those external users, they need a common basis under which financial statements are prepared. They need GAAP. This way, if they compare company A's financials, company B's financials, they've got common ground. Paired under exactly the same basis. You may have heard also in financial accounting that there is a base of accounting called IFRS, International Financial Reporting Standards. And that is for companies from other countries who have adopted IFRS, which quite frankly is most of the world. The United States hasn't, and I don't think it's going to. In fact, some countries who adopted IFRS no longer have the same exact set of standards that was supposed to be a uniform set for every single country. That just didn't happen. Well, anyway, IFRS, GAAP, they're based on each other. So you've got to have that uniform set of guidance. You've got multiple players, external players that is involved. But in this class, there is no hard and fast set of authoritative guidance. Instead, about the best you can see is company policy, which makes sense because we're trying to give the company what it needs internally. And that means just serve it up and give this company what it needs, what it wants. Now you'll find most things we do in this class are logical. So we find that students often like this class better because it does seem logical. GAAP doesn't always seem very logical. And another thing about this class is that sure, there's plenty of common. There's enough common material from one company to another that we can write a textbook about. So we don't have to worry. We have plenty of material. But again, I think you'll find it making sense, oftentimes, frankly, being easier to. Now, we will talk about GAAP in just a few places, it does enter in, but not that. So if you don't like GAAP that well, you're in luck. Now, another difference here is in the way of aggregation of information. That means accumulate. So we have aggregation over the company at a time. And also over or actually, let me just end that there because if we say something might be a little bit confusing. Okay. Let me just say aggregating over the company and aggregating over time. So back in financial accounting, information was very aggregate over time. because most information in financial accounting is reported for how long a period of time? A year. Very good. Aggregated for a year. Sometimes we had more frequent information like quarterly information, but generally aggregated over a year. Well, here in managerial accounting, we're trying to run a company and we wait for a year. Very often, information that's reported much more frequent, sometimes close to real time as we can get. When things get out of hand, we're trying to work together. Then, also information in financial accounting is generally aggregated for the company as a whole. So we report for the company as a whole. Sometimes we break things down further by company segments, but not that much. It's generally aggregated for the company as a whole. Well, again, if we're trying to run a company, we can't do that. We've got to have much more disaggregated information. For example, to individual employees. A really good example of a company that has quite disaggregated information is Publix. Every week, Publix runs an income statement on each of its over 1,300 stores, 1,400. So it runs a lot. Well, within that income statement, there is, of course, a lot of information that can be aggregated with the stores as a whole over that week and disaggregated into individual departments, individual employees, etc., and disaggregated into days or even hours or less if they so desire. They've got the technology to do it. And with artificial intelligence, this trend is just going to continue for a lot of companies. Last time that we had a student field trip out to Publix for the Accounting Student Association, which was over 2 years ago now, thanks to the pandemic. Well, I remember one of the managers said that with this income statement, that they can drill down into individual products that they like. They could tell in a store bakery if 1 key lime pie went to waste. They could do that and then take corrective action. Well, shouldn't make that many key lime pies, for example. So disaggregated information, yes, we need to run a company. Also, another thing when it comes to time is in the way of time orientation. So in financial accounting, as we talk about financial accounting information, we are talking about, well, over which dimension of time? As a cost principle named after it. Okay, historical cost principle. So we're thinking about information that's already taken place. So historical versus this class, both historical and future information. So historical cost principle in financial accounting. We don't record something as a transaction unless it's already taken place. So we are just reporting history. Well, if you're running a company, can you just look at history? Gotta look at the future too. We always think about that. Let's just glance at, oh, I'm sorry, fair line. There we go. Now we can see everything on the board. Let me just look here for one moment. See if there's anything else I need to pick up. Tell you from the book. Oops. There we go. And let's see. Oh, one final thing I should pick up. Some behavioral aspects. Just kind of put this all over to the side. Bring that down just here. So behavioral aspects, how the information we report affects employee. In financial accounting, we were unconcerned. Do you remember anyone talking about behavioral aspects? 2111. Yeah. They just crank the information out. That's what financial accountants do. But here in managerial, we've got to be concerned about human behavior, because what we report affects employee behavior. It truly does. We'll see a lot of examples of that as we go through the course. For example, one place we'll see it is as we discuss employee motivation a few chapters down the road, evaluating employees, things like that. Yes. That definitely makes a difference in human behavior. No, that's some interest for us too. Any questions there? Okay. Yeah, it's a nice thing about this class. I can always look around and see if anybody has any questions. Yeah, it's a really different environment than the big class I have right before this. I say big, I used to teach this course to like 500 students a term at UF, but like I said before, I don't think you want to be in that big section like that. Not very fun. So if you're online, I'm going to go back here to sharing my screen. Now, back here on the handout, looking at C. Well, management or managerial accounting information, two terms mean the same, will help management with displaying and controlling functions. For example, as we think about management, and one critical piece of information we'll need will be budgets. So a few chapters down the road, we'll look there at budgets. And with budgets, we're just planning for the future. We're putting in numbers, but we're planning for the future. For example, one budget that we will prepare is sales budget. And there we have how many units we plan to sell and the projected sales revenue, budget sales revenue. So then we're planning for the future. Then once that time period takes place, we can look at the actual number of units we sold and compare that back to the budgets. That's where we're controlling. So planning is projecting the future, controlling is controlling the past, and hopefully with the goal of making things better in the future. So in the case of a sales budget, the company wants to sell at least the number of budgeted units and at least the budgeted sales revenue. If it sells over, that's good. If it sells under, that's bad. And the company's going to take corrective action for selling under the sales budget. Find out what's wrong, prevent it from happening again in the future. Although we won't dwell on it, just to let you know, there is code of ethics for management accountants, and they're expected to conform to high standards. Well, the big professional organization for managerial accountants is the Institute of Management Accountants, and they have a statement of ethical professional practice. It's in your book, just glance at it when you have a chance. Just things like we're supposed to be ethical, looking at our conduct, things like that. It's short, sweet, and simple. Well, the next section here, Roman numeral 2, cost terms. Well, we'll talk about all kinds of different costs during the term. And that's why the upper division version of this is called cost accounting. If you go on to major in accounting, you'll take cost accounting. And most concepts we cover in this course, but they're kicked up a few notches in that course, of course. Whoa. Say that 3 times fast. In that course, of course. You get it. So when it comes to costs, let's discuss some different terms here. They're not difficult. And there are things we'll be working with throughout the course. So cost terms. First of all, what's cost? Someplace along the way, you may have seen a cost referred to as a sacrifice of economic benefits. The company gave something up. Just in personal life, if we have a cost, well, we're going to give up some economic benefits as well. And just like in a business, we will either give up an asset, usually cash, or sometimes we give up another asset directly for a cost, not too common. So generally we pay money, or if we don't pay money right up front, we will incur a liability. We say charged. So incurring an account payable is certainly another way that we can incur a cost. Well, accounting is normally based on historical costs, as we know, historical cost principle. Again, usually based on either the expenditure of cash or the incurrence of a liability. By the way, accounting is not based on opportunity or economic costs, which are the incremental benefit of a foregone alternative over the alternative chosen. So here at accounting, well, I should say financial accounting does not concern itself with opportunity costs. Maybe once in a great while, but that's it. Do you ever recall opportunity costs being discussed in 2111? In this course, we will at times. And opportunity costs can be difficult to identify sometimes. They're often fuzzier. Here's a good example. Let's go back to thinking about Publix, where Publix is outsourcing most of their carbonated beverages. So they are having Refresco, the Dutch company, make these over on Bartow Highway. And Publix decided it's better and cheaper for them to do so. So Refresco's making carbonated beverages for Publix. And let's say that Publix is paying Refresco 20 cents a can for a can of every says pie. So you say that no one else was, right? Okay. Well, I say pop. You'll know why. but Publix, let's see, that's good, 20 cents a can. Of course, Publix turns around and sells it for a lot more. Well, if Publix later finds that there is another company that could have made the cans for them for 15 cents, let's say. Well, they just bypassed saving 5 cents. That 5 cents they gave up is an opportunity cost. Obviously, we need to know about that during managerial accounting because we're going to try to capture the best bargains we can. We'll talk about insourcing versus outsourcing in chapter 18. Down the road. Okay. So that's an opportunity cost. Now in B, another term, cost object. It means anything for which a separate measurement of cost desired. Examples of product produced. So as we total up the manufacturing cost of a product, that is a cost object. So as we see the direct materials going into it and their cost, direct labor going into it, overhead going into it, there we're totaling up the cost of our cost object. And we'll have plenty of practice in chapter 17. Now see the term cost accumulation. That means recording cost data in an accounting system and aggregating the data in an account. Costs are then assigned, or we could say allocated or applied to cost objects to provide management with needed information for decision-making purposes. I just kind of want you to understand that concept now. Again, the next chapter will put numbers to it. But when it comes to this idea of cost accumulation and cost assignment, or other term you would like to call it, we're talking about overhead costs for everything to run the factory except for direct materials and direct labor. Well, with direct materials and direct labor, look at that finished product. And we can say exactly how much direct materials and direct labor went into that product. We'll know the quantity, we'll know the cost. With overhead, we don't have that luxury. Overhead is a lot fuzzy, use that term again. We can't look at finished product and know how much overhead goes into it. Items of overhead will be things like depreciation on the factory building and equipment, property taxes, insurance, the cost of maintenance, a whole bunch of different things where, yes, those costs are necessary to make product, but no, we don't know exactly how much in the way of cost goes into that product. So instead, we have to use something that's less accurate. We just have to average everything out, which is what this process of assigning the overhead is going to be. And we'll see in chapter 17 next. It will be hard. Now, I'd like for us to look at some different ways of classifying costs. Here in D, one way is as direct versus indirect. Yes, I don't have too much board space. I'll need to erase up here. And also let me go ahead and stop my share if you're online. Okay. So just make use of limited board space. one way of dichotomizing a cost, and one that we'll talk about a whole lot during the term. I'll go back to my notes here for just a second. So with direct versus indirect costs, well, direct costs of a cost object are easily related to it and can be traced to it in an economically feasible way. We'll see that process of tracing in the next chapter. But again, we'll know the exact amount of that cost object consumed. Primary way in which we'll discuss it will be for direct materials and direct labor. We can trace the exact amount of these to the product. For example, if we're manufacturing shirts, we know exactly how much in the way of fabric each shirt consumed. Again, both quantity and the cost. That is the direct material, one of the direct materials going into shirts. Then if we wanted to, we can keep track of the direct labor workers' time on the assembly line. We'll know exactly how much labor each assembly line worker is placing in the shirt. Again, both quantity in terms of time and cost. Trace direct labor and direct materials that finished product with the exact amount. That tends to appeal to us because we think of accounting as an exact science. It's always anyway. Now, on the other hand, when it comes to, excuse me, an indirect cost for cost object. Well, indirect costs for cost objects are related to the individual cost object, but cannot be traced to it easily. They'll be accumulated in cost pools. They will then be allocated to cost objects using an averaging system. Now, if that sounds familiar, we just talked about a couple of minutes ago. This is for overhead, where we don't know the exact amount, like we do direct materials and direct labor. So again, the next chapter will have this averaging system, and you can bet the averaging is not as accurate, quote unquote, as tracing will be. Again, we'll see that with numbers in chapter 17. Well, oh, here go the lights in the classroom. Okay. There we go. Sometimes it does, sometimes it doesn't. Sometimes that sensor detects us, sometimes not. So I was up here the whole time, but it still didn't detect me, which is why the timer finally went off. All right. Let's come back to the handout if you're online. So let's look at another way here to, excuse me. I'm sorry, whoops. All right, I'll come back to the handout here in a minute, but as I write something up here on the board, let's talk about capitalized versus non-capitalized costs. So another way of subdividing costs. Well, capitalized costs have future benefits, but thus capitalized or recorded as assets when incurred. And we're going to have a couple of different types. We'll have capitalized inventoriable costs or product cost pertains to products. They become an expense, namely cost of goods sold when sold, just as they did back with a merchandising company in 2111. We'll see the same thing here with the manufacturing company, except they produced what they sold. And we also have non-capitalized non-inventoriable costs. They pertain to assets other than two products. So with those, again, if you're online, you were looking at your handout. So costs, either capitalized versus non-capitalized. I'm just going to erase my direct and indirect. Oops. That's another thing, unfortunately. Not only did they leave this relatively small piece of board up here, but they managed to get it centered or almost centered right there on the seam. So that's not smooth. And well, when you write up there, the magic marker, it trips the marker tip up. So again, we can further subdivide a capitalized cost as capitalized inventoriable or capitalized non-inventory. Okay, so what am I talking about? Well, whenever we talk about a capitalized cost, the term capital pertains to an asset. And I wish to go over that term a little bit more frequently in financial, but the book just doesn't. But if we capitalize something, we record as an asset. So we spend money on a cost, we record as an asset because we consider it to be capitalized. What do we capitalize? Well, obviously inventory we do. So capitalized inventoriable cost in a merchandising company like a store that we saw in 2111, we capitalize inventory that we bought from someone else, usually from a manufacturer. Again, we capitalize that until we sold it. Then it became an expense, it became cost of goods sold. So it's an asset until that point of sale. Here in manufacturing, it'll be the same thing with the manufacturer, except that manufacturer once again makes inventory. So that manufacturer capitalizes the inventory again until we sell it. We'll deal with that process in chapter 17 in numbers. Now, if we have a capitalized non-inventoriable cost, that inventoriable cost, let me just make sure I have this up there okay for you. Yes, you're online. That inventoriable cost was only for inventory. Again, an asset other than inventory will be a capitalized non-inventoriable cost. So as we talk about something like a building or furniture or equipment or vehicles, all those are capitalized non-inventoriable costs. Well, if cost is not capitalized, it is non-capitalized. So it's not recorded as an asset. Instead, it's recorded as an expense or maybe a loss. So whenever we spend money on an expense, any old expense you can think of, wages and salaries expense, insurance expense, taxes expense, utilities expense, all those are non-capitalized costs. Let me define those a little bit better, a little bit more formally, I should say, by going back to my handout. So there, number 2, Non-capitalized costs have no future benefits, so they can't be an asset. And they're thus expenses. In other words, expired or period costs, we can call expenses that, or possibly losses. I'm not too concerned about what a loss is. It's very similar to an expense, except the loss is not incurred to directly produce expense. I'm sorry, to directly produce a revenue. Most expenses are incurred to directly produce revenue. Things like sales commissions. There's a good example of an expense incurred to produce revenue directly. But a loss doesn't do that. A loss is something that theoretically we probably should not have incurred. A good example is back in financial accounting, when you wrote some assets down to the lower of cost or market. We do that with inventory, for example, because sometimes inventory declines in market value below historical costs. We have to reduce the cost. That's called impaired asset because its current value is below its original cost. Gotta write it down. Gotta be conservative as why. So that loss from lower cost or market valuation is not really an expense. It's something that we incurred. Well, maybe we could argue as a result of some sort of carelessness. But it happens. Anyway, don't have to worry about it for this class. Well, then the next term, there number 3, operating costs, same thing as operating expenses, are non-capitalized costs, which are incurred to generate revenue. And operating costs include upstream and downstream costs, also the periodic expensing of capitalized non-inventoriable costs, which are consumed, such as depreciation. And many companies also classify cost of goods sold and operating cost. Your book does not, however. That doesn't really make any difference to us because it still is deducted on the way from revenue down to net income. So just want to let you know there that operating costs or operating expenses, those normal expenses that we see on the income statement, are a type of non-capitalized costs. Any questions so far? Righty? Well, another way that we can categorize costs is variable or direct. So let me come back up here to the board. Okay. You will have seen these terms if you've had economics. How many of you have had economics? Okay, 3 of you. Certainly isn't required for this class, but this will give you a good look ahead to economics if you haven't had. So let me just have a look up here and think about what's in the handout. I'm not going to display my screen here. It's short, sweet, and simple, but we see there on the handout that with variable versus fixed costs, well, variable costs change in a total as company's volume changes. That means what it's selling. It could be a number of units sold, or it could be as number of units produced, or sometimes even sales dollars. Basically, though, as we sell more and more of our product, volume's going up. Therefore, we would produce more and more of the product too. So volume sold and volume produced very closely correlated. So with a variable cost, well, as it turns out, a variable cost is quite easy to think about. If we don't produce anything, how much variable cost would we have? Nothing. And then the greater the volume that we have, either production volume or sales volume, the greater the number of units that we sell or produce. Therefore, variable costs go up in total. So variable costs directly related to volume. In fact, later on in chapter 19, chapter 18, as we deal with variable costs. We'll spend a lot of time doing this. Just make sure. Yeah, the camera's picking that up okay. Yes. We'll have plenty of graphs that look like this, and you had them if you've had economics. Can everybody see that? Okay. I know that pesky podium. So again, if we have zero volume, we don't produce anything, we don't sell anything, we have zero total variable cost. So the graph always starts off as a ray, a line that is coming from the origin. That's the order pair of 0, 0. That's what's on the x-axis, volume, first. What's on the y-axis, dollars, second. 0, 0. We don't produce anything. We don't sell anything. We don't have any variable costs. Then variable costs will slope upward. And the slope or rate of change will be price. So total variable cost looks like that. Then, so I change direct to fixed, pardon me. So I look here in the handout. Well, fixed costs do not change in total. Excuse me, as the company's volume changes. So total fixed costs, they just plain old stay fixed. So let me go ahead and show that up here. So. Fixed costs and volume. A fixed cost looks like this. It has no relation to volume. It's just plain old flat. It's fixed. So some good examples of fixed costs. If we thought about insurance on the factory, property tax on the factory, all but one type of depreciation on the factory or on the equipment. Straight line depreciation is definitely fixed. There's no relation whatsoever to volume. If we thought about salaries, that's where you earn the same amount, how many hours you work, which most professionals get. Example, I could work as many hours in my jobs I wanted to. I'm sure Florida Southern would be appreciative, but are they going to pay me anymore? No, they won't. All those are fixed costs. On the other hand, variable costs. With variable costs, we're talking about things like the direct materials, the fabric going into shirts, for example. As we talk about direct labor, the assembly line workers, they are usually on wages instead of salaries, which means if they get a wage, they don't earn more, or I should say, pardon me, they do earn more as they work more. So if you get a wage, you only get paid for the hours you actually work. So also with variable costs, as we talk about things like most electricity usage, it's variable. As we talk about one type of depreciation method, it's variable. Does anybody remember which depreciation method that is from back in 2111? Okay, it's units production depreciation. That one's actually variable. So we'll get into a lot of different examples of variable fixed cost labor. They're not difficult again to comprehend. So let me go ahead back. If you're online, I'm going to share my screen for a little bit. Now, coming back here and looking at number 3. Well, these relationships will hold true within the company's relevant range, or in other words, feasible limits of production within the short run, which is generally 1 year. So let's say that given our fixed factory facilities, the fixed building, the fixed equipment, etc., for right now, our factory can produce from 5,000 to 20,000 units per year. That's the relevant range. That's where we'll be seeing that the usual variable and fixed cost relationships will hold true. However, if we would like to reduce our capacity below 5,000 units, we have to downsize, which means getting rid of some facilities, some machines. That would lower the total amount of fixed costs. If we want to increase the relevant range, we would have to add to our fixed facilities, fixed machines, fixed building. That's going to increase total fixed cost. So that's why we just consider that. We won't deal with it much in this course whatsoever. By the way, in number 4, note the total variable cost is mostly a function of units. Because we produce more and more units, we incur more and more total variable cost. Whereas total fixed cost is normally a function of time. For example, if we had depreciation expense of $36,000 per year, well, the monthly amount of depreciation is going to be $3,000, 1/12 of it. So total fixed costs are really just a function of time. Our time goes by, the more total fixed costs we've got. So any questions there about fixed and variable costs or anything else so far? Now, NG, the term cost driver. Well, this means any factor which causes the cost change in total. And it's going to arise as an allocation base for indirect costs. As we average overhead out, it'll be based on a cost driver, something that causes the cost. We'll see that normally the cost drivers we will use will be either direct labor hours, direct labor cost, or machine hours. Again, the nitty-gritty of how to do that in the next chapter. But it probably makes sense. For example, most of the time, the total amount of overhead will go up as at least one of those goes up. Well, it's also known as cost determinant or cost generator. That's okay. And cost drivers thus link an indirect cost to a cost object. And cost drivers can be financial or non-financial in nature. We'll get into some others later on in the course. Then I'd like to just introduce a good way of categorizing costs as far as whether they are incurred before manufacturing or after manufacturing or in the middle during manufacturing. And that's called the value chain. So the value chain, how a factory adds value to the product. It's a means of dividing costs into the following. There we go again. Okay. Let's see if it picks up on me before I get all the way over. This time, no. Doesn't help one. This detector is a little strange. Well, before we go to manufacturing, we've got to have some sort of a product on the drawing board. We do that through our engineers. And the type of cost we have will be called pre-production costs or upstream costs, just like upstream on a river. So that's where our engineers are concerned with things such as research and development and product design, where they're trying to come up with ideas for a product and how to make those products manufacturable. Those are pre-production or upstream costs. Now, once a product gets the assembly line, that's where we have manufacturing costs. So those are incurred on the assembly line and they're for direct materials, also known as raw materials, by the way, direct labor and factory overhead. Then, after we manufacture the product, we still have some activities. So we'll have post-production or downstream costs. And these are for marketing, distribution, and customer service activities. The latter, things like warranties. For distribution, we're talking about how to get the product out in the hands of consumers. And for marketing, we're talking about the sales function, advertising, etc. Well, here's a little trick in number 4. All pre-production and post-production costs are expenses incurred. Manufacturing costs are capitalized as part of the cost of the product manufactured. They'll be expensed at the point of sale as cost of goods sold, just like we did in stores, retailers back in 2111. We'll do that with manufacturers in this course. So there's a timing difference there. So production costs, well, they're going to be expensed later, sometime after we manufacture the product. They'll be expensed at the point of sale. But pre-production and post-production costs, they're expenses incurred. So as soon as we spend $1 on one of those, that dollar hits the income statement. It reduces net income. Some other questions there so far. I'd like for us at this juncture to take a look at a few review questions, and that's where I got in my first section of the course, so we'll stop there too. So we'll get out early. Again, that dividend of time. going to go, whoops, to the very end of this handout. And I've got some chapter 16 demonstration exercises. Let's just do these, or I should say about half of them, so that we can illustrate what's going on. Some of these I'll save until Thursday because we haven't had the material yet. But as I go through the ones where we have had the material, we can do number 1. Recent companies, management desires cost information regarding their shipping department. And the shipping department is a cost what? We saw the term. Yes. No, although it's tempting, I see what you're thinking of. Okay, we can roll down. Yes. I see how that one's tempting too, but it isn't. Okay, so we'll roll down. Which one? Yes. Excellent. Object, you got it. Because we want a separate measurement of cost for it. Now, items 2 and 3 are based on the following information. Metallic Slugger Corporation manufactures aluminum baseball bats. And that's obviously a play on, well, it wasn't mine, it wasn't my example, but the author obviously had a play on which real life company there. Don't know? Okay, nobody played baseball. I didn't either. Louisville Slugger. Okay, aluminum baseball bats. So, following were among Slugger's manufacturing costs. Oh, let me not do that. Pardon me, there's something there we haven't had yet. Okay, say that until Thursday. And then if I ask, oh, a play on which real life company, everybody will say, you got. Yeah, it looks like it should be Louisville. And I think that's really the proper way to say it. But supposedly, the official way to say a place name is the way the inhabitants say it. So supposedly it's Louisville. Okay. Come on down to questions 4 and 5. Pardon me. So based on the following information, well, the shipping department of mail order clothing company had the following information for last year. I'll get to those 4 things in a moment. But I'd like to take a look at questions 4 and 5 so that we know what we're looking for when we go through them. Well, number 4, we're looking there for all the following or possible cost drivers, except, so look for the one that's not a cost driver, and number 5, the shipping department has variable costs of, so we'll total those up too. So let's come back to these 4 items. We'll decide if each one could be a cost driver and if each one is variable or fixed. So salaries, $400,000, and all employees are on guaranteed contracts, which means that they are earning salaries instead of wages. So would you say, first of all, this is variable or fixed? Fixed, you bet. Reason we know, guaranteed contracts, they're getting salaries, they're not getting wages. So they get the same amount of money, no matter how many hours they work. If this had been a wage, it would have been a variable cost. And as far as cost driver goes, what would it be? What would make total salaries go up outside of a raise? It would, yeah. But I was thinking number of employees, yeah. But you're right. If demand goes up, we would expect number of employees to go up because we need them. Well, then packaging, $200,000, varies with weight of item shipped. Would you say this is fixed or variable? Variable, you bet. If we ship a greater weight of items, we're going to incur more packaging. And, whoops, I just gave away the cost driver. Cost driver is obviously, yeah, the weight of the item shipped, but that's a variable cost. Again, weight, the cost driver. Then postage, $200,000, varies with weight of item shipped and distance of shipment. So fixed or variable? Variable, good. And two possible cost drivers, what are they? I was thinking of weight and distance. So tying into that, you're right. Then finally, the rent of the warehouse space, $100,000 on an annual lease. Would you say this is fixed or variable? Fixed, you bet. And as far as cost driver goes, it's time. Yeah. Monthly rent would be 1/12 of this annual amount, for example. So now let's answer questions 4 and 5. First of all, number 4. All the following are possible cost drivers for mail order shipping department, except which one did you say? It's D. Yes. So number of items shipping personnel work. That one is not going to be a cost driver. It's irrelevant because they don't get a wage. It's their tough luck. If they work more hours, they still get the same pay. Just like most professionals do. Then, number 5, mail order clothing shipping department has variable costs of. Okay, we had salaries variable, packaging variable, postage variable. So the total amount of variable costs would be how much? $400,000. Oh, I'm sorry. Oh, okay. Yeah, you're right. 400,000. Pardon me. I almost fell for the first one. I almost fell for salaries. So, yeah. $400,000, which will be packaging and postage. Salaries and the rent, those are going to be fixed. Now, looking at question 6. Which sector companies have no inventory? Oh, actually, let me see. I'll use it to explain something else first. Then 7. The book value, which means original cost less accumulated depreciation. We saw that back in 2111. Of machines used in a manufacturing plant is, would you say that's a non-inventoriable cost? Yes, because it's not inventory, that's why. Is it an inventoriable cost? Obviously, no. Is it a capitalized cost or an asset? Yes. So we're looking for yes, no, yes, and that is which one? C. Good. Then, looking at number 10. Direct and indirect costs are assigned to cost objects as follows. Cost allocation, that means where we are averaging things out. Namely, that's for overhead or an indirect cost. Cost tracing, is where we are tracing the exact amount of the cost. And we know that we do that for direct costs, direct materials and direct labor, in other words. So the answer there would be B. Okay, very good. So that's where I got to in my previous section. So I'll declare the rest time day lab time. Do you have any questions? Okay, well, very good. So we'll discuss more about manufacturing when we come back on Thursday. Also, I have a couple of videos about manufacturing. So other than that, have a good evening, and I'll look forward to seeing you on Thursday. Go enjoy a little bit of daylight left. Yeah, my hometown did not change time for 40 years. Yeah. Time can make people really fight. Oh, it really does. Makes them very angry. Thanks. Appreciate it. You have a good one too. I better make sure I take my eraser with me. There was no eraser up here, so I keep one stashed away in my office. Erasers and magic markers disappear in these rooms. Usually people take them to those study rooms over there. And someone here, they just appeared, left a whole bunch of markers and they fasten them together at the ends too. Those things dry out after a while, even if they're not used. Thanks, you do the same. See you Thursday. Bye-bye.